Hello and welcome to the Morningstar video, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Ian Heslock, manager of the Old Mutual Global Equity Fund. Hi Ian.
Hi Emma.
So to start by saying congratulations, because this fund is actually a Morningstar Award winner.
Thank you very much.
But that's probably the last of the good news because there seems to be bad news everywhere. You were just saying that the market is very opaque at the moment. There's so much unknown. And another day comes and we get something else. So perhaps we could start with China, get that out the way. What are your thoughts?
Well, I think with the Chinese market, you've got to recognise that the Chinese government are trying to do something that's quite difficult, which is move away from kind of an investment-led economy towards a consumption-led economy. And that will lead to some kind of hiatus in GDP growth. We've seen this before. Japan in the 60s was exactly the same thing. Does this mean the Chinese story's over? Well, probably not. Does it mean that there's a huge amount of volatility in equity markets, particularly in the Asian equity markets? Absolutely. I think the issue that we all have as fund managers and investors is the level of kind of very binary, very price sensitive, but very difficult to forecast issues, macro issues mainly, but just general issues which require an approach, I believe, an approach of diversification across different types of stocks. And that's what we've kind of hung our hat on for a long period of time now.
So China, of course, is a top-down challenge, but there are bottom-up challenges as well. There are certain equities, VW, Glencore, that perhaps, you know, even savvy investors would not have seen those stories coming. How do you invest in a market where you open the paper one day and see stuff like that? Yeah,
well, I think, you know, luckily we've avoided Glencore and we've avoided commodities. We haven't been positive on commodities for a while. Car manufacturers we haven't really been positive on for a while as well. So we've kind of avoided those issues. However, I think it's an issue of, again, of not taking large positions in either stocks, in sectors or styles, thematics, which is the way that we invest, this idea of thematic investment, trying to capture a number of different themes in a portfolio. Diversification being the object of doing that. And I think it's harder to kind of navigate through these types of markets when you've got a 20 or a 30 stock portfolio, which many people run. Whereas, you know, we're running a 400, 450 stock portfolio in global equities, so we're not necessarily going to get really impacted by any individual stock position. We do have to get the markets right, which is what we try and call the view that we have on what type of market are we in, what does that mean for investors, what are investors likely to do, what will they be buying, is more at the style level rather than at the stock level.
So then if you're not in commodity stocks and you're not positive on car manufacturers, what sort of themes are you looking at now?
Well, in general, the themes that we're interested in is quality. Unsurprisingly, given the volatility we're seeing in markets, I think investors are paying up for quality stocks. So expensive stocks that are also high quality stocks are obviously an area where we've been able to kind of shelter the portfolio from a lot of the volatility that we're seeing right now. From a sector standpoint, obviously healthcare is still quite positive for us. We don't really like utilities anymore. We used to be positive on utilities. I think utilities are more of a kind of a proxy, a bond proxy. And if you're in an interest rate environment that is becoming more unstable, then bond proxies are maybe not necessarily where you want to be. I think generally, again though, just taking large macro positions in equity portfolios, which, as I say, is an approach, I think will lead to instability in returns, in alpha, and the ability to beat indices in periods where you have this instability at the macro level. So thinking about the markets is what we do, trying to incorporate things that we think investors are likely to move towards. So, you know, do we want stocks in the portfolio that have performed well historically? If volatility is rising, probably not. We want to be kind of moving to a more stable viewpoint on markets. And I think that's kind of served us very well. As I said, over the last couple of years, we've been able to kind of see some of this coming. We obviously can't see everything, but I'm certainly not saying we'll go up every month, but we are able to kind of navigate through a very unstable environment. Certainly that I view the instability in the markets as being something that we've worked through for a long period of time, even though it hasn't really been unstable at a stock level. It's been very unstable within styles, within themes in the equity markets.
Ian, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.